Hello, everybody. This is kind of a special podcast edition because it's the day after the presidential election. Donald Trump, J.D. Vance versus Kamala Harris and Tim Walz on the Democratic side. So Republicans and Democrats duking it out. Americans going to the polls and voting, and making the case for what they believe and what they want to have happen in this country and this economy and in the markets. What's incredible and remarkable is the markets are ripping, and this is the next day. It's midday, and it's like the Dow is up like 1,400 points. The S&P 500's up a couple of percent. NASDAQ's up like over 3% in one day, not even a full day, like half a day. The Russell 2000 small caps are up over 5%. You've got green on the screen across the board. You've got everything happening. Everything's working. And it's a kind of a big deal. I've never seen it happen like this. My guess is there were a lot of people coming in with their investments, portfolio managers and the like, big money managers that were a bit too bearish, and they're having to cover that Harris didn't win, and they're having to cover those short positions. But also, this type of move warrants straight up credibility, like the communication and the viewpoint and the sentiment of what the future might be is lower taxes, higher earnings, more profitability, less government, meaning less size of government, the cost of government, maybe more efficiency in the government, and negotiations or renegotiations with foreign companies and countries when it comes to doing business with the United States. There's just a lot there that's being priced into the market, and it's being done in a favorable fashion in a big way. So whether it's short covering or it's sentiment shifting, I'm really excited about it. I think it's good. A lot of clients looks like are going to be making a lot of money this week. And I'm excited about reporting more and more and more about how earnings is going and how the markets are doing over the next coming weeks into the end of the year. And I suspect we'll probably get record highs. So, meaning like S&P 500 over 6,000, a continuing record highs. We've already had like in the 40s, like I think it's like 45 or 48 record highs this year. So I suspect that trend will continue. So stay tuned to this podcast. Stay tuned to what's going on in the markets, whether you watch any of the media outlets, but it looks like the future is bright when it comes to making money and the markets, given how Americans have voted. So, last thing, it also looks like there might be a clean sweep across the board for the Republicans. So not only the presidency, but it looks like the House and the Senate might actually be Republican as well. So it might be that there's going to be an acceleration of a lot and not a whole lot of rebutting and holding up on what the agenda is from the Trump administration going forward. Okay, that's all I got to say. We'll move on, and we'll cover the data, the statistics, the markets, the economy, and share with you personal financial insights. Stay tuned for the next segment. Hey everyone, when was the last time you checked your retirement contributions for the year? Here's a must-do year-end retirement checklist. Number 1, contribution limits for 2024. You can contribute up to $23,000 to most company retirement plans. Number 2, catch-up contributions. If you're 50 or older, you can contribute an additional $7,500. Okay, number 3, understand employer matches. Don't miss out on employer matches. Some consider the employer match to a retirement plan a key part of an overall compensation package. Number 4, required minimum distributions or RMDs. If you're 73 or older, remember to follow your RMD guidelines. Number 5, what about a Roth IRA? To qualify for the tax-free and penalty-free withdrawal of earnings, Roth IRA distributions must meet a 5-year holding requirement and occur after the age of 59 and a half. Tax-free and penalty-free withdrawals can also be taken under certain other circumstances, such as an owner's death. The original Roth IRA owner is not required to take minimum annual withdrawals. Take the time to review your retirement accounts. That's the point of this. It can make a big difference in the long run and how much money you have later in your nest egg, especially if you're younger. If you're in your 20s and 30s, start saving to those retirement plan accounts, and it's going to pay huge for you later. Check this out and more on www.northboundwealth.com. Stay tuned for the next segment. I really look forward to getting these earnings updates from Mr. John Butters in his blog. He's the vice president and senior earnings analyst at FactSet. Mr. Butters conducts a weekly research report called Earnings Insight, which provides analysis and commentary on trends in corporate earnings data for the S&P 500, including revisions to estimates, year-over-year growth, performance relative to expectations, and valuations. He is a widely used source for the media and has appeared on CNBC, Fox Business News, and the Business News Network. In addition, he's been cited by numerous print and online publications, such as the Wall Street Journal, Financial Times, the New York Times, MarketWatch, Yahoo Finance. Mr. Butters has over 15 years of experience in the financial services industry. Prior to FactSet in 2011, he worked for more than 10 years at Thomson Reuters Financial, mostly as the most recently as the director of U.S. earnings research from 2007 to 2010. So I do look forward to this report and want to give him full credit for it because I like these insights when he sends them out. Let's dive in. At this late stage of the third quarter or Q3 earnings season, the S&P 500 is continuing to report mixed results. Relative to estimates, both the number and the magnitude of positive earnings surprises are below their 5-year averages. However, the index is still reporting higher earnings for Q3 relative to the end of last week and relative to the end of the quarter. On a year-over-year basis, the index is reporting earnings growth for the fifth straight quarter. Overall, 91% of the companies in the S&P 500 have reported actual results for Q3 2024 to date, which is November 8th, 2024. Of these companies, 75% have reported actual EPS above estimates, which is below the 5-year average of 77%, but equal to the 10-year average of 75%. In aggregate, companies are reporting earnings that are 4.3% above estimates, which is below the 5-year average of 8.5% and below the 10-year average of 6.8%. Historical averages reflect actual results from all 500 companies, not the actual results from the percentage of companies that have reported through this point in time. During the past week, positive EPS or earnings per share surprises reported by companies in the healthcare sector and other sectors, partially offset by negative EPS surprises reported by companies in the utilities sector, were the largest contributors to the increase in the overall earnings growth rate for the index over the period. Since September 30th, positive EPS surprises reported by companies in financials, communication services, and consumer discretionary sectors, partially offset by negative EPS surprises reported by companies in the information technology sector, have been the largest contributors to the increase in the overall earnings growth rate for the index over this period. So did you hear that? More surprises on the positive side outside of tech, okay? As a result, the index is reporting higher earnings for the third quarter today relative to the end of last week and relative to the end of the quarter. The blended, or the blended, which combines actual results for companies that have reported and estimated results for companies that have not yet to report, earnings growth rate for the third quarter is 5.3% today compared to an earnings growth rate of 5% last week and an earnings growth rate of 4.3% at the end of the third quarter, September 30th. If 5.3% is the actual growth rate for the quarter, it will mark the fifth consecutive quarter of year-over-year earnings growth for the index. 7 of the 11 sectors are reporting year-over-year growth, led by the communication services and healthcare sectors. On the other hand, 4 sectors are reporting a year-over-year decline in earnings, led by the energy and materials sectors. In terms of revenues, 60% of the S&P 500 500 companies have reported actual revenues above estimates, which is below the 5-year average of 69% and below the 10-year average of 64%. In aggregate, companies are reporting revenues that are 1.2% above the estimates, which is below the 5-year average of 2% and below the 10-year average of 1.4%. Again, historical averages reflect actual results from all 500 companies, not the actual results from the percentage of companies that have reported through this point in time. During the past week, positive revenue surprises reported by companies in the healthcare sector were the largest contributors to the increase in the overall revenue growth rate for the index over this period. Since September 30th, positive revenue surprises reported by companies in the healthcare sector, partially offset by downward revisions to revenue estimates and negative revenue surprises for companies in the energy sector, have been the largest contributors to the increase in the overall revenue growth rate for the index over this period. As a result, the blended revenue growth rate for the third quarter is 5.5% today compared to revenue growth rate of 5.3% last week and a revenue growth rate of 4.7% at the end of the third quarter ending September 30th. If 5.5% is the actual growth rate for the quarter, it'll mark the 16th consecutive quarter of revenue growth for the index. It will also mark the highest revenue growth rate reported by the index since the third quarter of 2022, which was actually a negative 11%. 9 sectors are reporting year-over-year growth in revenues led by information technology, healthcare, and communication services sectors. On the other hand, 2 sectors are reporting year-over-year declines in revenues led by the energy sector. Looking ahead, analysts expect year-over-year earnings growth rates of 12.2%, 12.7%, and 11.9% for the fourth quarter of 2024, the first quarter of 2025, and the second quarter of 2025, respectively. Okay. For current year 2024, analysts are calling for year-over-year earnings growth of 9.4%. For current year 2025, analysts are predicting year-over-year earnings growth of 14.8%. Obviously, that's much higher. Maybe that's why the markets are ripping. The forward 12-month PE ratio is 22.2, which is above the 5-year average of 19.6 and above the 10-year average of 18.1. This PE ratio is also above the forward PE ratio of 21.6, recorded at the end of the third quarter, September 30th. During the upcoming week, 12 S&P 500 companies, including 3 Dow 30 components, are scheduled to report earnings for the third quarter. All right, so that wraps up this earnings EPS update, and I just got this hot off the press right before releasing this particular podcast. So this particular release is a little bit post what the other comments I made in other segments of this podcast are. I did have some sickness this week, so forgive me for that. And why I'm getting this podcast out a little bit late, but I cannot wait to dive back in next week and talk more about how the markets are performing, earnings, and all that kind of stuff. So stay tuned for the next segment. Here we go. Hello, everyone. Welcome to the Northbound Wealth Podcast. This is your host, Brent Foster, CEO of Northbound Wealth Management. And we've got the monthly market insights. This is a review of October. U.S. markets. Stocks fell in October as pre-election jitters hung over trading, but solid, not spectacular Q3 corporate reports failed to buoy spirits. The Dow Jones Industrial Average fell 1.34%, while the S&P 500 index slipped 0.99%. The NASDAQ Composite fell 0.52%. International news. Middle East tensions unsettled investors in early month as oil prices rose, but as the month progressed, prices fell back as investors took a more measured wait-and-see approach. Economic data, Wave 1, a bumpy beginning gave way to an upbeat jobs report from the Department of Labor, which boosted markets. The Fed has told investors that it's now focused on the jobs market as well as inflation, which elevates the importance of monthly jobs reports. Stocks continued their climb, with the S&P 500 and Dow Industrials hitting fresh record highs despite hitting a speed bump after the CPI data showed inflation was slightly warmer than expected in September. Economic data wave 2. A short time later, the Producer Price Index, or PPI report, showed that wholesale prices stayed flat last month with a welcome update after CPI data. Then, news that existing home sales fell to a 14-year low in October stymied markets. The third quarter gross domestic product showed 2.8% annualized growth, which was a bit short of economists' expectations, but sparked more talk of a soft landing. Q3 reports, or third quarter reports. As the Q3 corporate season kicked off, update reports from a few money center banks gave markets an added boost. But as the month wrapped up, mixed reports from a few mega cap tech companies unsettled investors who already seemed a bit anxious in the run up to the election. Sector scorecard. 3 of the 11 S&P 500 sectors were positive in October. Financials were up 2.56%. Communication services was up 1.81%, and energy up 0.90%. The biggest detractors were healthcare, down 4.64%, consumer staples down 3.47%, and technology down 1.56%. Meanwhile, utilities down 1.08%, materials down 3.10%, real estate was down 3.29%, consumer discretionary was down 1.74%, and industrials were down 1.19%, also trended lower. And that was October. In the month ahead, investors will adjust to the outcome of the November election, which has been one of the most closely watched U.S. cycles in recent history. While much focus goes on the presidency, what happens in the House of Representatives and the Senate can have more influence on the policy agenda in 2025 and beyond. Here are a couple areas to keep an eye on. Taxes. Individual taxes and estate tax rates are expected to come into focus given that the 2017 tax cuts are scheduled to expire at the end of next year. Corporate tax rates may also be revisited as discussions shift to what's next with the tax policy. Government spending. From infrastructure to defense to entitlement programs, expect the financial markets to react as different ideas are proposed, but keep in mind that most changes generally follow a legislative process, which may take time to unfold as issues are discussed and debated. World markets. The MSCI EFA index fell 5.50% in October, with several European markets under pressure during the month. France was hit the hardest, dropping 3.74%. Spain fell 1.72%, Germany lost 1.28%, and United Kingdom dipped 1.20%. Italy was the outlier, picking up 2.68%. Egypt dropped 3.79%, while Mexico declined 3.46%. India fared worse, falling 5.83%. Pacific Rim markets are mixed despite the global slump. Japan picked up 3.06%, while China's Hang Seng Index lost 3.86%. Australia fell 1.33%. So that's the world market recap through October. Let's talk about indicators. Gross domestic product. So the U.S. economy grew 2.8% on an annualized basis in the third quarter, slower than the 3.1% that economists expected, while the third quarter GDP cooled off slightly from the second quarter's 3% pace. Employment. So employers added 254,000 jobs in September, about 100,000 more than economists expected. Unemployment ticked down to 4.1% last month, the second month in a row of declines. Retail sales. So retail sales rose 0.4% in September, beating consensus estimates of 0.3%. September was an improvement from August, when month-over-month sales were flat. Retail sales were up 1.7% year over year. Industrial production. Industrial output fell 0.3% in September, weaker than consensus expectations of a 0.2% decline. The decline was primarily driven by workers' strike at a large aircraft manufacturer and by the effects of the two major hurricanes. Housing. So housing starts slipped 0.5% in September, driven by lower multifamily sales. Construction of new single-family homes, by contrast, rose during the month. The 0.5% decline stood in contrast to August, when housing starts rose. Year over year, total starts were down 0.7%. Sales of existing homes fell 1% to a 14-year low in September as high home prices and election jitters put the brakes on demand. This was the second consecutive monthly decline. Year-over-year sales fell 3.5%. The median existing home sales price was $404,500, up 3% from a year prior. New home sales rose 4.1% in September to hit a 16-month high as builders offered home buyer incentives. Year over year, new home sales were up 6.3%. The median home sales price was $426,300, up 3.7% over August. There were 470,000 unsold new homes on the market, representing 7.6 months of inventory. Consumer Price Index, or the CPI, that's indicator of inflation. Consumer prices rose 0.2% in September and 2.4% from a year earlier, slightly warmer than economists expected. Core CPI, which excludes food and energy, grew 0.3% in September over the prior month and 3.3% on an annualized basis, also warmer than expectations. Durable goods orders of manufactured goods designed to last 3 years or longer fell 0.8% in September, slightly better than expectations. The largest drag was a drop in civilian aircraft orders due to the strike at a major U.S. aircraft manufacturer called Boeing. Excluding that drag, durable goods orders rose 0.4% in September. Let's talk about the Fed. When the Fed concluded its two-day policy meeting on November 7th, Chairman Powell gave investors his near-term outlook for short-term rates, given what the Fed officials see with inflation and perhaps more importantly, the jobs market. Since 1977, when Congress amended the Federal Reserve Act, the Fed has the dual mandate of pursuing maximum employment and stable prices. Policymakers want an inflation rate of 2% as measured by the Personal Consumption Expenditures Price Index, while holding the Bureau of Labor Statistics unemployment rate at 4.1%. Over the next few weeks, investors will parse Powell's November comments to gain insight into what 2025 holds for the bond market and the housing market, which is influenced by mortgage rates. So, we've talked a little bit earlier in this podcast about how things are going in November post-election. Like the next day, the market's ripped. That was an indicator of what they think about potentially taxes in the future, and it being more beneficial for businesses and for people, for corporations going forward on profitability. So let's look at Thanksgiving travel, because Thanksgiving's coming up here very, very soon. The estimated number of Thanksgiving travelers last year was 55 million people. 49.1 million people are traveling by car. 1.55 million people travel by bus, train, or cruise ship. 4.7 million people travel by air. The total number of international and domestic flights flown by U.S. carriers last November was 713,160. So revenue passenger miles flown last November by U.S. carriers was 86.5 billion. The average cost of a plane ticket on Sunday, the most expensive day to fly, $392. The best time in advance to book a flight, 25 to 38 days in advance. Average cost of a plane ticket on Tuesday, the cheapest day to fly, $243. The average amount saved by booking a plane ticket a month in advance rather than last minute is 10%. The average cost of travel insurance based on your non-refundable trip expenses is 6%. The proportion of flights that were on time last year was 77%. The proportion of flights that were delayed last year is 21%. The proportion of flights that were canceled last year was 1.5%, and the proportion of flights that were diverted last year is 0.25%. So that's kind of fun facts. Be safe while you travel for sure. And check out our blog on Northbound Wealth Management's website. You can check us out. If you have any questions over personal finance or how markets are doing or how you should be allocated in this next market cycle with a new regime and policy coming down the pike in the coming years, reach out to us at 317-399-1107. Until then, have a great week and weekend, and we'll talk to you next week. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, and tax advice or as a solicitation to offer or buy any securities. Clients of Northbound Wealth Management may maintain positions in the securities discussed in this podcast.